In this video, you'll learn how to find the best entry points using universal principles that work in any market situation. These models are simple, logical, and appear on the chart all the time. That's why I apply them on a practically daily basis. At the end of the video, I'll show public stats for 10 months so you can see how these methods actually work in practice. Finding entry points always starts with understanding market structure and identifying zones where the probability of success is highest. The first type is the end of an impulse move, when new higher highs are formed and the market enters a correction phase. In such conditions, counter-trend trades are relevant, offering the chance to open short positions with a high probability of success. The second type is the end of a correction, when structural higher lows are formed. Here, on the contrary, we look for a long position following the direction of the main trend. Thus, by identifying the trend on any time frame, you'll always understand exactly where to look for an entry, so the trade has the highest probability of success. Entries in the middle of a move on a breakout or based on candlestick and chart patterns should be skipped, as this is a field for smart money manipulation. In a bearish market, everything happens in reverse. When a lower low forms at the end of an impulse, counter-trend longs are opened, and when a lower high forms at the end of a correction, trend-following shorts are taken. And now we'll break down how to do this consistently, precisely, and systematically. The work begins with identifying an uptrend structure and a trading range from the last higher low to the higher high. This allows us to understand the scope of the future correction and determine where premium and discount prices are located. The main focus is on the range below the 0.5 level, the discount price zone. This is where smart capital shows the most interest in buying, and our task as a smart money trader is to follow its actions. Next, you need to ensure there's a support zone in the discount market. Most often, this is an imbalance formation, less often an order block. Mitigation and breaker blocks are significantly rarer and due to their specifics are not covered in this video. A local minimum should be located above the support zone, an internal sell-side liquidity pool that smart capital uses for buying at discount prices. The trade entry is made with a limit order from the start of the imbalance. This is a conservative and most reliable approach, providing the greatest number of high-quality entry points. But if you want to improve your risk-to-reward ratio, check out my video on imbalance. Alternative triggers for opening trades are discussed in detail there. The stop loss is placed below the first candle of the imbalance formation. There are usually two take profits. The first is at the last structural higher high where the correction began. 50% of the position is fixed here. The second is at the start of the resistance zone above it. A reversal might start here, so the trade will be closed. Further development shows the formation of a complex correction. Within an uptrend, a local downtrend emerges. The swing low updates and the bullish imbalance partially rebalances. This indicates that during the correction phase, smart money tackles two key tasks: reaccumulating long positions from liquidity under local lows while attracting new liquidity and setting the current price as fair. Buy stop orders concentrate above each local high, and their activation fuels the continuation of the uptrend. Thus, smart money, without significant effort, steers the price in its desired direction and secures a profit. This type of trade execution is standard price action that occurs on a daily basis. Entering at the end of an impulse is a counter-trend trade. Our task is to identify the moment when a new structural higher high is most likely to form and a reversal will begin. To do this, it's vital to ensure the growth has reached a significant institutional resistance zone, like an order block. On the other hand, you must have a clear downside target that the price will aim for. Typically, this is an imbalance in the discount market. In such conditions, a downside expectation forms, but opening a trade requires extra confirmation via a reversal pattern, M3 drives or M plus SMT. These form at almost every reversal, so entry occurs only after they have fully developed. This provides us with several advantages. Reversal confirmation, which protects against entering too early, a high probability universal setup for counter-trend short positions, and a high risk-to-reward ratio. Two key signs to watch for are a break in structure when a structural higher low is updated and a fresh bearish imbalance. These factors point to active selling by smart money and its interest in further devaluing the asset. The first correction is usually the most predictable and deep enough for an optimal entry, so a short limit order is placed at the start of the SIBI stop loss behind the first candle and take profit at the first major support. In our example, the reversal occurs through a classic bearish M pattern confirmed by a structural higher low update. The appearance of a bearish imbalance is a key sign of a developing bearish order flow, which is where our interest in shorting begins. In this situation, a limit order is placed at the start of the imbalance. Stop loss behind the first candle of the pattern. The first take profit is set at a local liquidity pool, the second at the start of the FTA zone in the discount market, with volume split 50-50. During a local correction, the bearish inefficiency partially rebalances and our trade is filled. After that, the movement naturally accelerates. This is typical dynamics after the first correction, and uninformed traders miss the chance to enter at favorable prices. Targets are reached and the position is fully closed. As you know, this is one of the simplest and most reliable counter-trend trading approaches that can be used in any market and time frame. And to help you do this safely and systematically, let's look at risk management and the risk-to-reward ratio using my own example. This table contains all my public trades from the trading group over the last 10 months. Analytics are conducted on a daily basis, and each post has a simple yet systematic structure. The zone of interest, where the entry is executed from the start. The scenario invalidation level, shown as a crossed-out I symbol. A conservative stop loss is placed behind it. Target levels where profits are taken. Everything is posted well in advance so that everyone has the chance to execute the trade along with me. If the RR column has no value, it means the trade didn't affect the result for one of two reasons. It wasn't opened because the price reached the target without testing the zone of interest. In the win rate, this is shown as BO, or the position closed at break-even, BE. We didn't lose anything, but we didn't make anything either. This usually happens due to partial profit taking or moving the stop, which reduced the risk to zero. I started keeping this table from the moment the trading group was created. In the starting deposit field, a nominal amount of 10,000 was specified. This, I believe, is the optimal size for most community members. Today, it stands at 37,000, which is a growth of over 370% in less than a year, solely due to discipline and compound interest. Yes, the win rate might seem low, but for daily trading without picking only A+ setups, it's a phenomenal result. And just look at the average RR. In any case, if you're able to trade better, message the manager, complete a trial period, and we'll definitely work together on great terms. The key to such a result is absolute stability in risk management. Every trade was opened with a 1% risk, and this rule was never broken. The work was done using compound interest. If the initial deposit was 10,000, then at a 1% risk, that's $100. After the first winning trade, the deposit grew to 10,200, and now 1% equals $102. This is the exact amount we risk in the next trade. Profit grows not by increasing the position size, but through the stability of the system. While 2% profit used to yield $200, now it's $750. This is the most reliable and effective way to grow capital. This is exactly what I'm demonstrating in practice. Now, about the risk-to-reward ratio, RR, I aim for a final result of no less than 1 to 2. This is optimal for daily trading. Higher values, like 1 to 3 or 1 to 4, occur less frequently and cannot be part of a stable model. A simple formula for systematic trading: 1% risk, RR of at least 1 to 2, and compound interest. This is enough to grow steadily and preserve capital. In this video, you've learned when to look for a trade entry and which formations provide the best entry points. The material turned out to be as practical as possible. Even beginner traders will be able to apply it immediately after watching. The main thing is to follow risk management and use compound interest. This is the key to systematic and stable earnings in the market. Subscribe to my Telegram channel because there I regularly share my observations, ideas, and current market reviews. Good luck.